Hello, good morning, everyone. Welcome to all of you for today's session. Students, in the last class, we were discussing capital rationing, the topic of capital rationing, and I'll proceed with the same today. So in the last class, let me give a quick overview what we have covered in the last class. So, students, we said that capital rationing can be of two types. One is called single period capital rationing, and the second is multi-period capital rationing. So single period capital rationing is that capital rationing where funds limitation is for one accounting period. Funds limitation is for one accounting period only. And multi-period capital rationing is that where funds limitation is for multiple accounting periods. Okay? Where funds limitation is for multiple accounting periods. Now, next point. So, yes, so single period capital rationing. We said that the purpose of the company, the purpose is, what is the purpose? The purpose is to maximize shareholders' wealth. In other words, they have to select best or optimum investment plan. They have to select optimum or best investment plan. Remember that for the business. So let us proceed. So let us proceed. So single period capital rationing. So in case of single period capital rationing, in case of single period capital rationing, when the funds limitation is for one accounting period only, so optimum investment plan. Okay, two cases may be there. Available projects are divisible. They are indivisible. When the available projects are divisible, we say that use profitability index to select best investments. And we have done one example on the same in the last class. If available products are indivisible, we say that use make combination within funding constraints. Make combinations of projects within funding constraints and choose best combination. And choose best combination. And choose best combination. Now, we will have to do this example first. For example, available funds are 1,000, 10,000, okay. And available investment projects are project A, B, C, and D. Investment required is 4,500. NPV is 2,200. Investment required is 6,000. NPV is 2,800. Investment required is 3,000. NPV is 1,500. Investment required is 1,000. Okay. Yes. NPV is 400. So what are the available funds? 10,000 only. 4 products are available. We have to choose best investment plan. We need to choose best investment plan. So the best investment plan will be, how it will be? We will be making available, yes, combination 1. So we can add A and C, project A plus C, investment A plus C, 4,500 plus 3,000 is equal to 7,500. And NPV earned 2,200 plus 1,500, 3,700. That is NPV. Combination 2. Combination 2. That is equal to okay. That can be formed. A plus B plus C. Yes. So we need, that is within 10,000. My mistake. We have to add B as over here as well. B. So C is 1,000. That is 8,500. So NPV earned will be, this 400 will also be added. 4,100. Now combination 2. B plus C plus D. 6,000 plus 3,000 plus 1,000 is equal to 10,000. So B plus C plus D, 2,800 plus 1,500 plus 400, 4,700. So 2 combinations are available. C plus D is not a combination because available funds maximum utilization. So 2 combinations are available, and combination 2 is the best combination with the highest NPV because it is having highest NPV, and they should go for that. And they should go for that. Any confusion, any problem, any question, please, you can ask. Now, students, so single period capital rationing, we have discussed 2 cases. There may be a third case in the same. If they say, for example, project A and C are mutually exclusive. They can attach this condition. What does it mean? It means you cannot take these two projects in a go together. So then this combination is not possible. Then A plus B is possible only. C cannot be taken. Or A plus C is possible. So then A plus C, one combination. The second will be A plus B. Two more further combination will be formed. Like this. So A plus B. So A plus B is not possible. B plus C is possible. B plus C is only possible. Yes. That is already here. That is already here. So A plus C. B and this we cannot. A plus B plus C or B plus C. Yes. So A plus C we will take. That is 4,500 plus C 3,000. 7,500. A plus C. My mistake. Yes, A and C are exclusive. I'm sorry. A plus D we need to take. I'm sorry. A plus D we need to take. It is 5,500. I will give you one more example. Don't you worry. To make you think more clear. A plus D. So NPV is 2,200 and 400. 2,600. Now come to the another example. A fresh example we will write and solve. Available funds are 25,000. Available projects are X, R, M, and P. Investment needed, that is 12,000, 6,000, 9,000, and 4,000. Available investments. NPV of each investment, 5,500, 3,000, 4,700, and 2,300. Now, you have two options. They say devise best investment plan. Number one, projects are divisible. They are indivisible. They are indivisible. So projects are divisible. And now you see here. Here we calculate profitability index. NPV divided by investment, divisible. We are going to solve first. So NPV divided by 5,500 divided by 12,000. 0.458. It is 0.5. It is 0.522. 0.575. So profitability index is calculated. Now we can do ranking as well. Ranking. Highest rank. Second, third, and fourth by chance. Yes. So divisible projects, ranking is done. And now investment plan. Projects, yes. So available investment is 25,000. So project, the first is P, highest ranking, 4,000. And its NPV is 2,300. NPV is 2,300. So remaining investment is 21,000. Second, project M, minus 9,000. Its NPV is 4,700. So 12,000. Then is project R, 6,000. NPV is 3,000. Remaining is 6,000 investment. Now project X, 1,200 investment. Project X, 12,000. We have 50% of that. So we have 6,000 out of 12,000. So 6,000 divided by 12,000. We have this. And its NPV, 5,500. It is 2,750. So 6,000 divisible project. Part of the project we will take and 2,750. The sum of this will be the best investment plan through profitability index. Now, the next is if projects are indivisible. This is the best investment plan. Invest in P, M, R, and partly of X and get this NPV. The next is if projects are indivisible, we will make combinations. So combinations. Constraint is 25,000 investment. So combinations 1. X plus R, X plus R, 18,000 and P. So investment required is how much? 12,000 plus 6,000 plus 4,000, 22,000. And NPV will be 5,500 plus 3,000 plus 2,300, 10,800. This is within the constraint. Combination 2. RMP. R plus M plus P. R 6,000 plus 9,000 plus 4,000. 19,000 within constraint. NPV 3,000 plus 4,700 plus 2,300. 10,000 NPV of these three projects. Any other combination possible? Two combinations possible, the best. So the best combination is combination one, XRP. Invest in that. Now, the next point is, for example, condition is that project XMP. The question is, can we make XMP? Is it? No, we cannot. Why not? Investment required is 12,000, 600,000 plus 9,000. It is 27,000. Investment constraint is 25,000. We cannot make. Not possible. Okay? Is that clear? No, it is 6,000 XMP. Sorry, XMP. Okay, XMP. You are right. It is possible. Make that plus P. That is 12,000 plus 9,000 plus 4,000. Okay. Yes, 25. It is possible. Exactly. Combination 3. So NPV. The next is NPV. XMP. X, M, and P. 5,500 plus 4,700 plus 2,300. Yeah, now this is the best combination. That is 12,750. Thank you. So this is the best combination. Exactly. Combination 3. That's it. You see, trial and error. It is all about trial and error. Next. So we will be going for one past exam paper question scenario on it. This is the question. DYSXA. Please read the requirements and the question, then we will solve it. What they're saying, calculate the NPV of investment project and comment on its financial acceptability. Discuss the NPV of optimum investment plan for delta division. It is going to be a wonderful question. Discuss the reasons why hard and soft capital rationing occur. So we will talk about it. I am opening an Excel sheet because such questions are done in exam on the spreadsheet. It is section C type question. Yes. So first of all, NPV of the project. The last part we have not yet done, risk and uncertainty. Have we done that? I don't think. No, we have not done that. That's why we cannot discuss it. Calculate the NPV of a project. NPV of this project. So DY SXA company is looking to expand the capacity of existing factory in its alpha division by 85,000 units per year in order to meet increased demand for one of its products. The expansion will cost $3.2 million. Now, the selling price of unit is $3.1 per unit and variable cost of production are $1.1 per unit, both in current price terms. So, the selling price of inflation of 3% per year and variable cost inflation is 6% per year. Our nominal fixed cost is given here. They have after tax WACC of 10%, paid tax 20% per year. In 1 year in arrears, they can claim 25% reducing balance basis capital allowance on full cost of expansion, which you should assume is paid at the start of the first year of operation. 4 year life. Okay, this is the capital rationing part. Now we will start working. So working first of all, they say existing demand 850,000. So by 850,000. So this is the sell. So first of all, sales we need to calculate working. So selling price inflated at the rate of 3% per year because 3% to year 1, 2, 3, and 4. So in the first year, this is current selling price 3.1, current price terms. So 3.1 into 1.03 raised to power this. And it will be increasing by the same rate every year. You can see the formula I use, that is future value is equal to present value into 1 plus R raised to power n. What I used. Now, the next point is selling price. Sales will be 850,000 is the total units which is production, same every year. Into this is the sales value. Okay, 850,000 into selling price every year. Then is the variable cost per unit inflated at 6% per year. That is equal to current price term, $1.1. Yes. And let us proceed. So variable cost, this into 850,000, sorry, total variable cost. Here you go. Next. The next point is fixed cost nominal already. So another working that is capital tax saving on capital allowance. So tax saving on capital allowance. The working has to be done. Now see here. They say that company can claim capital 25% reducing balance basis. Okay. Scrap value is zero. Life 4 years. Initial investment is 3.2 million. So year 1, 2, 3, and 4. 3.2 million. So written down value 3.2 million. So capital allowance is 25% reducing balance basis. So that's here into 25%. Written down value, this minus this. Into this 25%. This minus this. This into 25% capital allowance. Last year, written down value, the whole will be charged. Zero scrap value, minus zero. Whole will be charged as capital allowance. Now tax saving on capital allowance equal to this into tax rate 20% in arrears. For year 1, tax saving will be in year 2 arrears. In arrears, here we go. Next. So all the working is done. We will go to the body of the question and we'll do working there. 0, 1, 2, 3, and 4. Sales less variable cost. Variable cost. Less fixed cost. Now fixed cost is here. 110,000 minus 205,000. They already said it is inflated. Nominal means inflated. Minus 330,000. Minus 330,000. Now, taxable cash flows. Taxable cash flows. Tax rate 20%. This. Now, initial investment. 3.2 million. Zero scrap value. Tax saving on capital allowance. That is here. Tell me one thing. Why I didn't charge tax in the first year? I need answer from you. Why I didn't charge tax in the year one? Any idea? Why I charged the year two? The answer is tax payment is in 1 year delay. For year one, tax is here. For year two, tax is here. And for year four, tax is in year five. Same is the saving. Same is the saving. I hope you got the idea now. So the net cash flows. From this to this. So present value we need to calculate at the rate of 10%. Sorry, present value of cash flows. Equal to this into 1.1 raised to power minus this. So NPV is equal to sum from here to here. Yes, NPV, net present value of the project. Comment as the NPV of project is positive, so it will lead to the wealth of shareholders of DY, I don't know what is the name of the company. 𝐷𝐌𝐻𝐧 company. So it should be accepted comment. Yes. Let us proceed further. The next part, the NPV of optimum investment. They have funds in the Delta division 7 million. So B part. Investment plan for Delta division. Yes. They say initial investments, NPVs. All projects are divisible. C and E are mutually exclusive. Very good. So both things are being tested. So projects A, B, C, D, and E. Investment required 3 million, 2 million, 1 million, 1 million, and 2 million. The next is NPV. $6 million. Really? Strange. More than investment. It happens. Yes, practically it happens, especially nowadays in the IT startups. It is happening. Yeah, 21 million, 3.6 million. Now, students, projects are divisible. How to calculate best investment plan? Available funds. Available funds are 7 million. Now, see here, please. So we need to prepare what profitability index? NPV divided by investment. NPV divided by, now ranking has to be done. Highest ranking, second ranking, third ranking, fourth ranking, and fifth ranking. So ranking as per profitability index. Ranking is done. Next, C and E are mutually exclusive. Means we cannot take both together. So investment plan, investment, NPV, NPV, project. Highest is the D. Sorry, first of all, available investment. Available investment is 7 million. Yes. So D has highest profitability index. So investment required is this. NPV of D is here. So remaining funds, this. So this is the remaining funds. Second is the A. Investment required is this. NPV is this. So available funds are here. Third ranking is of E. Investment required is this. NPV is this. The fourth ranking is that of C. We cannot take C because we have already taken E and we can take both of these. So we will ignore C. C, we write here, C will be ignored. As we have already taken E and these both are mutually exclusive. We will mention that. This statement is very important. Then we will take fifth one, B. We have to calculate remaining investment first. Remaining investment. So B. So B requires this investment, but we can invest only this 100,000. 1 million, sorry. We can invest in 1 million. Investment required is 2 million. So half of that, so this divided available investment divided by total investment into NPV. Next. So total NPV will be this. NPV. The best investment plan. So the best investment plan is to invest in project D, A, E in full and part of project B. There you go. Any confusion you can ask. Then they say, discuss the reasons why they occur. We have already discussed reason, causes. You have to discuss in the paragraphic form. One paragraph on the hard capital rationing, one soft. The soft capital rationing occurs because of internal reasons. Because management doesn't want to take much risk. They want controlled growth. Management doesn't want to commit too many fixed interest payments, so they don't want to take loan. Or management thinks that if we take too much, issue new shares, our earning per share will be diluted. Control will go in the hand of other people. Control of the company will be disturbed. It will be changed. So soft capital rationing and hard capital rationing, it occurs because of external reasons, external factors. For example, the government has imposed restriction on the banks for lending. Banks are demanding high amount of security, high value security, which is not available with the company. Stock market is not valuing the shares of company properly. Interest rates are high in the market than the normal. So you see here, so the reasons. Now it is done. The next topic we have to start is risk and uncertainty in the investment appraisal today. Okay, so risk and uncertainty in investment appraisal. But after a short break of 5 minutes. 5 minutes, we'll be back. Continue. Hello. Now, we are starting risk and uncertainty in the investment appraisal. So risk and uncertainty in the investment appraisal means that since investment is about future, we are evaluating a future project today, and future is uncertain. So whatever we are forecasting today, that is about future. That is about future. And future is uncertain. We all know. So, students, what is risk and what is uncertainty? In both cases, there are several possible outcomes. In both cases. Uncertainty means there are 2-3 possible outcomes. 4, 5, 6, 7, even 10, 15 outcomes are there. And second thing, but in the case of risk, probability can be assigned. And you can quantify risk. You can quantify risk. In the case of uncertainty, probability cannot be assigned. You cannot say what will happen. What are the chances of A option, B option, C? Yes, but it may not remain the same. What we are predicting right now. So not quantifiable. So risk and uncertainty. Yes. So techniques to address risk and uncertainty are here. So first of all, probability analysis. We will talk about. Probability analysis is basically we calculate expected values that is equal to sigma px. You multiply probability with x, with the amount, you multiply with that, and then px. So you see here, for example, you are there is a chance that the price will be 60, chance that it will be 40, chance that it will be 80. 3 chance. Future. This is X. And there is a probability that it has chance of 30%, 0.3 or 30% same. It has a chance of 70, okay, make it 50%, chance 20%. So Px, this will be multiplied with this. Px. $54 sigma Px. So here we are. That is the expected value. Sigma Px. So probability that we actually account for the multiple options there, what we call relevant probabilities, and calculate one amount, that this will be the price, expected value. But expected value has some drawbacks as well. You see, what is the drawback? This Px is the weighted average, and it is not in fact, 3 possibilities are there. Either it will be 60, 40, or 80. 54 is not an option out of these 3. And we are using this in evaluation, which is not reasonable. And this is the weighted average. It may never occur. It can occur only expected average value is a weighted average. And it can occur only if project is repeated many times. So we take average of that. And majority projects are one time. They are not repeated. You say this 54 will achieve when you launch this project again and again, again and again, same product again and again, and then calculate average. 54 will be the price. And probabilities assigned 60%, 30%, 40%. Probabilities, again, they are subjective, judgment is involved. And this expected value eliminates risk. And it ignores the attitude of investor, basically. Ignores the attitude of investor toward risk. So it is a very good method. Different probabilities are quantified. And it helps to make a decision. Now, next point. The next point is, this is joint probability and I will help you to solve it and understand it in the Excel sheet, not here. Let me open, because it is a very big question and it is tested in FM as well. That's a fact. Let me open it on my screen of the laptop. Joint probability. Do you read this question for the time being? I'm opening it. Read this question. Yes. So I am opening this in front of you. Yes, here it is. What they're saying that a company is considering investing in a project. Outlay of initial investment 300,000 and cash flow over the 2 year are here. Cash flow in the year 1, probability. Cash flow in year 2, now you see conditional probability. If in year 1 is 100,000, there is probability that year 2 will be these 3 options. If in year 2, 1 is this, second one, there is 3 probabilities in year 2 as well. If in year 1 there is 300,000, further probabilities. Cost of capital is 10%, expected NPV. Now, understanding of question is the first thing before we proceed. Understanding of the question is the first thing before we proceed. So, cash flows, just first of all, what we need to do is focus. How to solve such question? Year 1, what are the cash flows? 3 options. Okay, year 1, second option. Third option. Year 2. First option is 0. Second option is 100,000. Third option is 200,000. Okay. Same 100 and 200. Third option is 300,000 in year 2. Again, year 2, 200,000 already included, 300,000 already included, and 350,000. Now, these are the total cash flows. Now focus. We need to calculate present value of these cash flows. Focus. Future value into 1.1. 10% is the discount rate. They said raised to power minus this. So life is easy. Simply apply the formula, present value. Now focus. We will make a table. We will make a table now. So year one, they can get 100,000. So year one, present value of cash flow. Yes. Year one. Probability of 1, P1. Year 2. Present value of cash flows. Probability P2. Year 2 probability. Now focus. This table, if you understand, you can do anything about it. Listen. In year 1, the first option is you get 100,000, which has present value here. Year 1, probability is, the first option is 100,000, which has present value here. And it has probability 0.25. Okay. Now in year 2, three things are dependent on it. Three further probabilities. So we will write it 3 times. Because in year 2, further 3 different cash flows are expected based on it. 3 different scenarios. So year 1, we have written 3 times. This one. Now focus. Year 2, the first probability is 0. 0. The second probability is 100,000. Year 2, 100,000. Present value. Third probability is 200,000. Present value 200,000. And this cash flow 0 has probability of P2 0.25. This has probability of 0.5. This has probability of 0.25. I repeat my words. Year 1, we calculate present value. Year 1. Now it has further 3 branch options: nil, 100,000 and 200,000. So nil, 100,000, year 2 present value, 200,000 present value. Okay. So they have relevant, yes, their respective probabilities attached: 0.25, 0.5 and 0.25. Here we are. Is this clear to everyone? Tell me, is it clear to everyone? Is it clear to everyone? Tell me what I have written so far. Good. There is no objection. Silence means okay. Now, if in year 1 is 200,000, so year 1, 200,000 has present value here. Again, it has to be 3 times. In year, next 3 outcome dependent on it. So 3 times I will write. Occurrence of year 1, 200,000 has probability of 0.5. Now, the first option in year 2, with its occur 100,000. So year 2, 100,000, which has the probability of 0.25, which has the probability of 0.25. Second option in year 2, again 200,000, which has a present value and probability of 0.5. Third is 300,000, which has this present value and probability of 0.25 again. Is 0.25. I repeat again and again and again. Focus. In year 2, there are 3 possible outcomes attached with year 1. This one. So this in year 1 will this, and in year 2, 0, one option. So one time we wrote. Year 1, this, second option this, third option this. That's why we wrote 3 times. Same is the case for the year 2 as well. 200,000 as well. Is that clear now? If in year 2, there are 4 options, we will write it 4 times here. Tell me, please, is it clear? Now, year 3, year 1, third option, 300,000. Year 1, third option, this is the present value. Again, 3 are dependent, so we write it 3 times. It has a probability of 0.25 in year 1. So what are the options in year 2 with it? Equal to 200,000 present value, 300,000 present value, and this present value. And their probabilities are 0.25, 0.5, and 0.25. This cash flows combinations in year 1, these combinations, how many combinations there are? 9 combinations. 1 will occur out of these 9, practically. Either in year 1, they will get this, and year 2, this. Or this, in year 1, and then this, second year, this. This or this, and this. These combinations will be there. Now, this I call X1. This I call X2. This is joint probability we are doing. Remember. So X1 plus X2. Total present values. So X1 plus X2. Joint probability. How is it calculated? P1 into P2. P1 into P2. Joint probability. P1 into P2. Now, if I say that is equal to P, X1 plus X2 is equal to X. So now Px, P into X. Here we go. So sum of these all This is the expected value. This is the expected value. This is the expected value. Cash inflows. So expected NPV will be present value of cash inflows minus investment is 300,000. Initial investment is 300,000. This is the expected NPV. Now, listen. Then they say the first part, expected NPV. And probability that, very important, focus. Probability that NP will be negative. Now, student, listen. We know that investment is required is 300,000. We know that. We have to keep that in mind. So if present value of cash inflow is less than this, NP will be negative. Now focus. Focus. For that purpose, we need to do one thing. Present value of cash inflows. Year one. Yes, here it is already calculated, by the way. Here it is, X. So here it is negative. It is less than 300,000. Less than 300,000. Less than, up to this, they're all less than 300,000. So NPV will be negative if any of these options occur. The first four combination, NPV will be negative because investment is more, present value of cash inflow is less. You see, this is total cash inflows, present value. And their probability, sum of probabilities, 37.5%. Probability that NPV is negative. You see here, which I added. I added where it is negative, the cases. So there is 37.5% probability that NPV will be negative. And what is the probability of positive? Inverse of it, 62.5%. I hope this is clear. If there is any confusion, you can ask. The next point. So risk-adjusted discount rate we have to discuss in the WAC topic. Discounted payback is a way to incorporate risk. We have already done it. Next. So techniques to address uncertainty, sensitivity analysis. Very interesting. Very interesting. So sensitivity analysis. Sensitivity analysis. So sensitivity analysis basically, we call it measures responsiveness of NPV of a project towards a change in a specific variable. In other words, it tells how much a variable should change to make NPV 0. Next, students, basically we are trying to figure out critical variables that only where a small change in those variables can do upside down, make NPV 0, so that we can watch and do something with those variables. Next, so sensitivity analysis. How sensitivity is calculated? So sensitivity is calculated is equal to NPV of a project, present value of post-tax variable. We will learn it by example. Don't you worry. We will learn it by example. Now, let us do some example. So, come here. For example, a project has sales. Okay, the sales are these are the sales, and variable cost is here. Fixed cost is 10,000 negative equal to this into 1.05. Yes. So taxable cash flows. Here, tax rate is, for example, 20%. Then, so net cash flows. Now, so present value, for the cost of capital is 10%. Cost of capital. This into 1.1 raised to power minus this. I'm taking assumed figures. Okay. So NPV, we need to calculate. And initial investment, let us do it. Initial investment, that is 25,000. So NPV we can calculate. So present value of cash inflows minus this. So NPV is here. So the requirement, calculate sensitivity of NPV towards number one, sales or selling price. Same meaning. Sales volume. Number three, variable cost. Number four, project life. Fifth, discount rate. Yes. So we need to calculate. Next. The next is we need to calculate. So first of all, one by one, let us pick selling price or sales. Okay. So here 1, 2, 3, and 4. So sales are here. Post-tax sales. This into 1 minus tax rate. Post-tax sales. And then present value of post-tax sales at 10% cost of capital. This into 1.1 raised to power minus this. Yes. So present value of post-tax sales. Here we are. Next, sensitivity. The formula is NPV divided by this. Percentage. What, how to interpret it? Sales, if sales fall by 18.8%, NPV of project will become 0. It will become 0. Yes. Next. Next is variable cost. No, next is sales volume, sorry. Sales volume. For that, we need contribution. Sales minus variable cost. This is contribution. Post-tax contribution. This into 1 minus 0.2. Here we go. So present value of post-tax contribution. This into 1.1 raised to power minus this. Post-tax contribution, present value. So total present value. Same. So for sales volume, we need to calculate present value of total contribution. So now, sensitivity, NPV over this. So if sales volume fall by this percentage, NP will become 0. Is it clear to everyone? Tell me. So far, any question before I proceed? Tell me, please. Now, next. The next third, variable cost. Now, variable cost is very easy. You simply do it post-tax. 11,250 into 1 minus t. All. Calculate present value and calculate this figure. Very easy. Okay, let me do. Variable cost. Post-tax variable cost. This into 1 minus 0.2. So present value at 10% equal to this into 1.1 raised to power minus this. So present value of post-tax variable cost. Now, so we can calculate sensitivity. NPV over this. This is 62.6%. Now it's interpretation. If variable cost increase by this amount, NP will become 0. If variable cost increase by this amount, then NP will become 0. Next. The next is discount rate I will do first. For discount rate, what we need to do? We need to calculate IRR of the project. So IRR of the project, internal rate of return. Simply select from here net cash flows of the project. Okay, there is one thing missing. Got it. Investment is not here. Investment we can add here. That is how much? 250,000. Okay, 25,000 equal to negative this. So IRR. %41 is IRR. Now listen, IRR is the rate at which NP will become 0. Current cost of capital is 10%. So 41% minus 10%. This is increase required in the cost of capital to make NPV 0. Current divided by 10%. This is the percentage increase required. This is total increase. This is percentage of current value. 310%. How we calculated? Sensitivity. Let me write the formula as well for you. We calculated IRR minus cost of capital divided by cost of capital. This is the percentage increase required. So if cost of capital is increased by 3.010% of its current value rate, it will become, NP will become 0 of project will become 0. NP will become 0. The last but not the least, this project life. We will calculate project life. Very easy. Project life. For that, we need to calculate, first of all, let me write here the cash flows. Year 0, 1, 2, 3, and 4. Year 0, negative this, and then present value of cash flows. We need to calculate discounted payback. So present value of cash flows. Cumulative cash flow. Discounted payback we need to calculate. So total is this negative. Next year, this is recovered. Next year, this is recovered. Now, 2-year complete. And part of 1901 divided by part of year 3 will be utilized. So 2.18 year is the discounted payback in which only initial investment present value is recovered. Current life is 4 years. If life is reduced to 2.18 years, so it's only NP will be recovered. Okay, so you see here, total life is 4 years. How much they should reduce? 2.8. 2.18. Reduce to this level. How much it can reduce? This it can reduce. And how much it is percentage of current life? 4. It can reduce to, I will write the formula for it as well. How I calculate it? Life minus discounted payback divided by life. You can see. So if project life is decreased by 45.5% of its current life, NPV will become 0. Yes. NPV will become 0. Students, I will give you some homework again. Okay. I told you to do some question last time. Have you done that question? Tell me. How many of you solved the question which I gave you last time? Tell me, please. How many of you? No one? Okay, good. Well done. Now your homework is, you have to do the question 295, note down. And 296. This copper question is similar to one we did. 295 and 296 is your homework. Okay. So in the next class we'll be meeting. Enough work is done for today. You need to prepare it very well. We'll be meeting in the next class. And we will be most likely winding up investment appraisal. This section will be completed. So next class will be the 4th class. It will be completed. And then we will continue practice, practice, and practice. Or OTQs, section A and B. And even C is continued. 2 questions I have given you for the homework. And next we will be meeting in the next class. That's it for today. God bless you. Take care. Goodbye.